How's it going, everybody? Welcome back to the channel. My name is Jay, and today we're talking about RYLD, the Global X Russell 2000 Covered Call ETF. RYLD has a 10% dividend yield, and it pays dividends monthly. So we'll take a look at how RYLD works, how it stacks up in the world of covered call ETFs, and whether or not RYLD deserves a place in your income portfolio. RYLD is an income ETF offered by Global X. It's a sister ETF to everyone's favorite QYLD. And much like QYLD, RYLD generates the income it passes on to its investors by selling covered calls against an index. The index that RYLD uses as the basis for its investments is the Russell 2000 index. Now, the Russell 2000 is an index just like the S&P 500 or the NASDAQ 100 or the Dow Jones, except that while those indexes are mainly focused on large cap stocks, the Russell 2000 is an index of small cap stocks. Small cap stocks are stocks that have a market cap of anywhere between $300 million and $2 billion. Because these are much smaller companies with much smaller market capitalizations, small cap stocks are generally more volatile, carry a higher level of risk, but also a higher potential for growth than stocks you generally find in the S&P 500, for instance. So as you can imagine, smaller companies in the growth stages of their life cycle are generally less likely to be dividend payers. So how does a fund like RYLD give you a 10% dividend yield off of these kinds of companies? And like we mentioned, it does it through covered calls. RYLD is a very simple ETF. It only has two holdings. The first, it holds ticker symbol VTWO, which is Vanguard's Russell 2000 Index ETF. And the second is the monthly at-the-money covered call it sells against that index ETF. Yeah, that's it. It's buying a Vanguard Index ETF and selling covered calls against it. And now would probably be a good time to mention that RYLD carries an expense ratio of 0.7%. That's higher than QYLD, it's higher than NUSI, which has a much more complex strategy, and it's higher than JEPI, which is an actively managed ETF. So why do I need RYLD at all? Can't I just do this on my own? Yeah, you can. To replicate exactly what RYLD is doing, all you need to do is first buy at least 100 shares of VTWO, which again is the Vanguard Russell 2000 Index ETF, and then each month sell an at-the-money covered call against those 100 shares. It's a simple strategy. Anyone can do it. Brokerages like TD Ameritrade and Fidelity only charge you 65 cents per options contract. So buying those 100 shares and selling that contract against them would cost you a total of 65%. So why would anyone need an ETF like RYLD? And there's two main reasons I can think of. First is price. To be able to implement this strategy on your own, first you need to be able to buy a minimum of 100 shares of VTWO. And at the current price of that ETF, that's going to set you back about $9,000. Now, after you buy those 100 shares for roughly $9,000, you do get a chunk of that money back once you sell the covered call against it in the form of the options premium for that call. RYLD, on the other hand, trades for $25 per share. So if you don't want to spend $9,000, $10,000, $20,000 implementing this strategy on the Russell 2000, you can use RYLD and invest $100, $500, or $1,000 if you want. So you can get into RYLD, you can reap the benefits of this kind of strategy against the Russell 2000 for far less money than if you were to do it on your own. And the second reason I can think of that someone would turn to RYLD instead of buying the ETF and selling the covered calls on their own is time. To replicate RYLD's strategy on your own, at the very minimum, you're going to have to log into your investment account once a month and sell a new at-the-money covered call with a 1-month expiration date. Now, if any given month your prior month's call was exercised, you're going to have to go through the whole process again. You're going to have to buy another 100 shares or 200 shares or whatever, and then write the covered call against those new shares that you've purchased. Now, that's not really a major time commitment we're talking about here, but it is something you would have to stay on top of, something you would have to remember to do each and every month. So RYLD simplifies that process, makes it so you don't have to do a thing. You can just invest in RYLD, sit back and relax. So if the two advantages of RYLD over simply buying the VTWO ETF and selling the covered calls yourselves are just a smaller initial investment and a small time savings each month, is that convenience worth a 0.7% expense ratio? Unless for some reason you really want a Russell 2000 covered call ETF in your portfolio, I don't see a real need to invest in RYLD. You can get a higher yield than RYLD by investing in QYLD. You get it at a lower expense fee. And when you combine it with 3 other income ETFs, you can create what I think is the best income ETF portfolio available. And you can watch a video on that right here. Thanks for watching.